Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, as always, Michael Becker.
Hey, Paul.
And also James Eng with Old Capital. Hello, James.
Hey, Paul. Thanks for having me.
So I want to make sure that everybody remembers that what's coming up. We do have Dr. Dotzer.
March 28th, Grapevine Convention Center.
March 28th, as Michael calls him, the funniest economist in town. He's just not for the Texas economy, but he's a national economist. And we really enjoy Dr. Dotzer when he comes up. He was the chief economist for 18 years for the Texas Real Estate Center down at Texas A&M University. And we get a lot of information from him about what's going on. So we look forward to having him at the Grapevine Convention Center.
March 28th, doors open at 6 p.m. Presentation starts at 7. So some good networking before, and we always tend to go get some drinks afterwards too. So that would be good as well. So definitely go to oldcapitalpodcast.com. You can sign up for it there. Coming up in the not too distant future, we have the second annual Old Capital Conference. That'll be at the AT&T Stadium where the Cowboys play. So that'll be pretty cool. If you haven't been there, it's an unbelievable venue. So I'm pretty excited to see what the conference would be like at a big, massive football stadium. So it'll be interesting for me to figure out along with you guys too. So that'll be on September the 13th. That'll be an all-day event. That one is not free, but you certainly can come sign up at the same website, oldcapitalpodcast.com. So link to the tickets there. And we're kind of offering basically early bird pricing right now. Yeah. And we do expect to raise the pricing as we get closer to the event. So that is our two plugs. Paul, who do we have today on the podcast?
So the podcast today, we have another economist, I would say, probably not the smartest guy in the room, maybe not the second smartest guy in the room, but he's in the top one or two. From Johns Hopkins University, he did his undergrad, and now he works with a group called CoStar. And so he covers the Dallas-Fort Worth area and the multifamily, office, retail. He kind of does everything, but this is his territory, and he knows it well. So in the podcast today, we have David Kahn. So David, thanks for joining us. We appreciate your time.
Thank you guys for having me. And I would say if you're the smartest guy in the room, you're in the wrong room. So definitely not in this one.
So I want to kick it over and let's kind of talk a little bit about what's going on in the market these days. So Mike?
Yeah, I'll take the reins here, Paul. So David, maybe a good place to start is kind of give a little background on yourself, kind of professionally, and then maybe tell everyone who is CoStar, your employer. I'm sure most people are probably familiar with them, but maybe you can give a pretty good background on it.
Great. Well, again, thanks again for having me. And I'm David Kahn, Senior Market Analyst for DFW. Been covering the Metroplex a little more than 3 years. For CoStar, focused on all the commercial property types, so multifamily, industrial, office, and retail. A little bit about CoStar, so a lot of people may know us as really commercial-based, so office, industrial, and retail. But when we acquired Apartments.com in 2014, that really raised our game in the multifamily space. So getting a lot of data via the marketing of Apartments.com. Everyone knows Jeff Goldblum doing those ads, you get more people advertising, and you get more data from that. So we're a data company. That's obviously the marketing play is one thing, but it allows us to do a lot of great things with multifamily data.
That's great. So to kind of recap, you have, as Paul likes to say, maybe like a black box, right? So you get all this data in from listing on the apartments.com and kind of all the advertised rents, which are generally generated and fed by having the revenue management softwares that all the potential properties that basically have on their thing that feed their rents into apartments.com. And you can take all that data and kind of understand what the general rental rates and occupancy and all that good stuff are on hundreds and hundreds of thousands of apartment units or millions of apartment units across the country, right?
Yeah, you said it better than I could.
There you go.
We have that. And then our research team really is the bread and butter of what we do at CoStar. Hundreds of people just focused on multifamily. And then dozens of economists like myself, like Sam Tenenbaum down in Austin, who this is all we do, cover the market and talk about the economy and focus on the major property
I
types.
can almost promise you, if you own an apartment, someone from CoStar and you buy it or you sell it, someone from CoStar is going to ask you what you paid or what you sold it for. So I've gotten several of those phone calls.
Yeah,
along the way.
CoStar is a very good data collector. You may know it if you're just starting out in real estate and you're looking to buy apartment buildings by another tagline, which is not CoStar, but you may know it as LoopNet.
LoopNet.
Yeah. So tell us a little bit about LoopNet too.
So LoopNet is really we talk apartments.com as marketing. LoopNet is the marketing arm for commercial space, so including multifamily. So a lot of deals that are out there, they're on CoStar, they're on LoopNet. That's the way to market the property. CoStar is the way to gather data on it.
That's great. So kind of the main event of the podcast, why we want to have you on, is maybe just kind of talk about the state of the market, essentially. Kind of we're recording this in the middle of February 2018. So kind of what's the state of the market? Maybe we kind of just start high level and then kind of drill down in a little bit. First and foremost, do you have any sort of just general comments about the national economy for 2017? How did the year kind of end up, and then kind of where do we sit as in the first part of 2018, just from like a national economic standpoint?
Well, nationally, 2017 was another solid year, slow growth. I mean, that's just been the entire cycle, slow growth, but focusing a little bit more on multifamily in general, we're not building the housing that we have in the past. And really our shop view is we're not building the housing, we're not building the single family housing. And we've seen this massive boom in multifamily. And that's concerned a lot of people. But if you look at it at the margins, we're adding more households, where population growth is still strong nationwide. And we're seeing this great price appreciation in really some of the most aggressive markets that are seeing the most job growth. But as a whole, we're seeing a lot of price appreciation. We're still seeing pretty solid rent growth overall because there's still, you don't want to call it a shortage of housing because that raises eyebrows, but we really haven't added the amount of housing that we have in previous cycles, while we have added all those jobs back and more.
So generally speaking, nationwide, the household formation is outpacing the supply of new housing, both on the multifamily and the single family side. Is that a quick way to summing it up?
That's fair to say. And the real culprit there is the single family. A lot of people got burned in the last cycle. We're not building as much, and we really can't in many metros that are seeing some of the best job growth. California, as we know, there's just not enough room. The regulations are very strict. So there could be more housing there. There could be more population growth. There's just not enough room.
So are we seeing, one of the headlines I always hear, especially just on the single family development side, it's in Dallas Fort Worth area, which is probably similar to a lot of other major metros. It's just the entry level home. If you go back 10 years ago, a brand new starter home in Dallas Fort Worth would go for $150,000. The new starter home in Dallas Fort Worth is now $300,000+. Is that kind of what you've seen consistently across the nation?
Absolutely. And it's a lot of different factors. And I could speak more confidently about Dallas Fort Worth, but you can't develop a lot for under $200,000 anymore.
And that's just regulation?
Yeah, that's all just regulation and what the costs are to build a single family lot. Then you put on top of that, the local jurisdictions, they don't want $200,000 homes anyway. So they're pushing for that $400,000 plus the demographics that come with that. And the places that are seeing, we see the other day, Kaufman County, they're seeing a big development, Forney, Salina, that's where all those single family homes are being built. And the more established, the more dense suburbs, inner ring suburbs, that's primarily multifamily now.
And so for those of you guys that don't know Dallas Fort Worth that well, that's really, really far out, basically.
Yes,
so
middle of nowhere.
Yeah, places you don't want to go unless you can't afford anywhere else. Not that they're bad places, they're just far. So you'll be stuck on the tollway forever and ever. So maybe let's quickly talk about one of the most recent topics that's been, hot on everyone's tongue is the most recent tax reform that we have. So what's kind of your view on tax reform and how that has impacted the economy, good or bad?
Well, I think it's a net positive, especially in the near term. And then focusing more on Texas in general, a net positive when it comes to just the way the tax structure is here compared to obviously the Northeast. I don't think that it will cause a structural change. There won't be people from northern New Jersey who are all of a sudden going to flock down to low tax, no tax states because of this, but it's not going to hurt. So you have those structural factors already in play. This might be a little bit of a nudge on the margin, if you will, but in general, a net positive, especially short term. Longer term concerns, obviously, with the national debt, longer term concerns with inflation. Is this going to cause the economy to overheat and then cause rates to rise faster than expected? those are all, more midterm concerns. But, 2018, 2019, pretty status quo at this point. That's our shop view, at least.
Yeah, I mean, inflation impacting interest rates, I wouldn't say is midterm, it's right now.
Right. Yeah.
Well, it sure seems to be that. Do you have any sort of commentary on that and kind of obviously this is a super speculative crystal ball question I'm about to ask you, but the last, 2 to 3 months, we've seen a pretty sharp rise in the 10-year treasury rate from the 2.2, 2.3 range all the way up to about 290 as we record this podcast. So, we've seen 60, 70 basis points expansion in the 10-year treasury. Do you have any sort of commentary related to that and kind of what you anticipate going forward for the rest of 2018 or into 2019 as the 10-year treasury, I guess, goes?
Well, I don't really want to forecast treasury rates. The Fed does a bad enough job of that themselves, but right. James and I, actually my boss worked at the Atlanta Fed for about 10 years before joining CoStar. So talked enough about that. But no, James and I were talking before this, just it's going to possibly do a change. People are revisiting what they're looking at. It's changing things as it's happening right now. So it's just the thought of, how are we going to have to rethink this deal? Is it going to change it? Is it going to make or break the deal? Or are we in on this all the way? And what are the fundamentals of this deal rather than having to predict something what's going to happen 2-3 months in the future?
Okay.
Do we want to jump in now on DFW and maybe...
Why don't we start nationally and kind of work our way
sure.
down? So, I mean, what's the state of the national apartment market? I know you kind of talked about the national economy, but what's kind of you have any more things to add on the national apartment market? I know you kind of just touched on it, but generally speaking, are we pretty healthy across the nation? Any sort of metro areas outside of the Texas area that might jump out to you, good or bad?
Yeah, pretty healthy. Overall, the really strong rent growth markets are still those late recovery markets in general. So the Florida markets, Orlando, incredible rent growth over the last 4 quarters. Then you have your Vegas and your Sacramento housing bust markets, even Phoenix. You're seeing better rent growth, but that's more of they just recovered a lot slower than the rest of the nation. Your big one, DFW, Atlanta, still chugging along really strong despite all this supply. And then the coastal metros, San Francisco, LA, New York, you're starting to see rents getting to that unaffordable range. And rent growth has been pretty slow in the Bay Area, been pretty slow in New York. There's other factors involved there, but those are slower growth. And then you have your smaller metros, Austin, San Antonio, Nashville, ton of supply. It was on everyone's list the last few years. You throw in Raleigh and Charlotte. Those are a lot more volatile. If you add, a couple extra 1,000 units there, that could tank rent growth. But if they see a little bit more in-migration than they typically have seen, you could see a huge surge in demand. So a little bit more volatility with those metros.
On those late recovery markets like Atlanta and Phoenix, is it because the investor demand is going in there and rehabbing these units, and they were in maybe Dallas, Houston, Austin before, and now they're going out there to search for yield? Like, why is it taking so long for those rents to come back in those markets?
I wouldn't put Atlanta with the same as a Phoenix. These are established markets. These are big, massive economies. So I think the value add play, it's everywhere. It's everywhere right now. And people looking at that and then looking at tertiary markets for chasing those yields as well. At least that's what we're seeing now. When it comes to Phoenix, a market like that, not seeing as much supply as you typically would if you're looking back of the envelope or looking at, what the in-migration is. Orlando was like that a few years ago, where the job growth was really great and they weren't really building that much. So rent growth popped in 2017. That late in the cycle, so you still see that people are still skittish because of the housing bust markets, and late in the cycle you can see things like that.
Are those markets now starting to see supply chase all the positive growth? Is that kind of generally the theme that we're seeing 2018 beyond?
Big uptick in Orlando in terms of supply, and then you have like your Nashvilles, which it's pretty much in one submarket, but you see a lot of supply as a percent of inventory, and it's because they've really grown in terms of that office using employment growth. And, the growth of the metro was so strong early this cycle, trying to catch up a little bit. There could be a little bit of pain, or there has been a little bit of pain the last few quarters.
Good. So maybe we kind of then start drilling a little bit. Most of a business that we do a lot of business across the country, but obviously we're based here in Texas. Before we get to Dallas, Fort Worth, do you have any kind of general comments about the Texas economy, and then maybe kind of touch. I know you focus on DFW, so you're not as up as your counterparts would be on Austin, San Antonio, Houston, but general Texas economics comments, as well as kind of maybe compare and contrast the major four metros of Texas.
Sure. Yeah, the Texas economy and the Texas metros, I view it almost as a release valve. I mean, the Sun Belt in general can be viewed that way. A lot of open land, easier regulations, better weather than the Northeast, and a release valve for the West and East Coast, where things are just getting too pricey for office tenants, people, individuals trying to buy a home or rent an apartment in a nice area, everyone looking for good schools, good neighborhood amenities. Texas metros bring that. You can bring your family here, like Toyota. You could bring a company, don't have to pay them more. You could pay them the lesser the same, and they can afford a nice home or a nice apartment in a good area. So as the release valve, we can pretty much build our way out of being structurally underbuilt if that ever happens. And again, that household formation versus housing starts and apartment deliveries, as we mentioned before, nationwide, we saw that in Texas, but we were able to more quickly build out of it and kind of get to an equilibrium over the last few years.
So that's kind of general comments. What's kind of your view of the four major metros and how they kind of differ from each other, and your observation? What would be kind of I don't know if we want to stack rank them or whatever, but kind of what's the stack ranking from your view on a go forward basis of what seems to be the most stable and potentially has the most growth of the four major metros in Texas?
Sure. Well, Houston is energy central, and that's not going to change. There's structural reasons for that to be the case. Port of Houston, Gulf Coast, all the infrastructure that's there. So people say, try to diversify Houston away from energy. It's not going to happen. So Houston, you live and die by the price of crude and fracking and shale boom and everything. So that a little bit more volatility when it comes to compared to other metros. Austin, a little bit more land constraints, pricier, a lot of that tech jobs, high paying jobs. So that drives the market there. But as I mentioned with Nashville, for example, it's still a very small metro, Austin.
About 1.5 million people in the MSA, give or take.
About 2 million if you really spread it out there. But a slight imbalance, we're talking a couple thousand units here or there of supply, and you could see rent growth really tank like it did last year. It was pretty weak last year, and a lot of that's driven by that high-end 4 and 5 stars, we call it A-class, that's suppressing rents in all the asset classes. San Antonio, much more slow and steady. You don't see the big headline relocations, but the fundamentals there are still strong. The in-migration is still very strong as well, even though it doesn't garner the headlines, and it's a little bit more affordable. And DFW is just really the best of all worlds. The great airports, the infrastructure, as I will mention later, the warehouse distribution industrial sector has just boomed. So e-commerce, it's going to be in Dallas. We are in the middle of the country. We have all the infrastructure. We have the know-how. We have the flat land. It is ground zero for the e-commerce boom. And I think we're really only seeing the beginning of that. And then we're adding a ton of office jobs because of these corporate relocations. So we're adding them at the top, the middle, the bottom, and that's great for rental demand in all of the asset classes, A, B, and C.
So before we get a little bit deeper in DFW, if
Sure.
you had to stack rank them, it sounds like Dallas, in your opinion, and obviously you cover Dallas-Fort Worth, so you know a little bit better, but Dallas would be at the top, and then kind of where would you put the other metros in order?
I would probably go Dallas, Austin, San Antonio, Houston. Houston, in the caveat, the Harvey jump, we were able to look at rents on a daily basis, and rents pretty much jumped up 3% overnight.
Uh-huh.
So we've seen that, and the apartment market's done well because of that. But overall, just the energy dependence makes it difficult to kind of edge out of that. But of course, there's obvious upside there, which we saw earlier this cycle.
So jumping into DFW, I mean, you had a couple highlights here, and we'll sort of take them one by one. Maybe talk about the job growth in DFW compared to the rest of the nation and sort of how it stands out.
So we've about doubled the nation in terms of percentage job growth this cycle. And what that means nominally, 100,000 to 120,000 jobs per year. So how does that account to rental demand or households? It's a lot of housing demand that we're bringing. That's just going to be absolute. That it's been incredible for the apartment and single family market.
So if there's 120,000 jobs, what is that kind of from like a total population kind of year over year? What does that translate to? How many people do 120,000 jobs attract to the MSA like Dallas?
Well, you still have, especially earlier this cycle, you still have a little higher unemployment. Right now, we're about 3 unemployment. So the number of jobs we're adding, it's going to be almost all people we're importing. That unemployment rate's not really going to get much lower than 3%. So earlier you had a little bit of that, but pretty much divided by 2 gives you a good household estimation for housing units.
We have 100. So if we have 120,000 jobs, it'll probably be about 60,000
households
household formation, but probably more like 150, 200,000 actual people moving into the area.
140, 150,000. Those are the numbers that typically pencil out. And there's always give and take about that. I get the question about it all the time. How does this match up? But those are decent rules of thumb. Yeah.
On that 120, do you know how much is sort of corporate relocation and how much is sort of organic growth from companies expanding here in the metro? Do you have that broken out at all?
That's a great question. And again, a question that I get a lot. It's really difficult to parse that out. But in terms of the drivers, that's the driver. It's the corporate relocations. And then again, the logistics, the warehouse distribution, that absorption, all those, the Amazons, all the 3PLs, third-party logistics firms, just UPS, FedEx. I mean, these are tons of jobs that are still coming to the Metroplex.
So I know in Dallas we like to build. So how many units do we have coming on this year compared to last year? And is that enough or is it in balance with where you see absorption?
We are a little over 20,000 this year. I see some higher numbers sometimes. We like to hedge around construction delays a lot. So we'll push out a lot of our supply into later years. We've learned that developers are pretty aggressive with their construction timelines. Sure. And then you have phasing and phase 1, phase 2. So about a little over 20,000 last year, this year, next year, pretty similar as well. So how does that match up to absorption? Just due to the lag of properties leasing up, absorption is going to be a little bit slower. Vacancies are going to rise. That headline number is going to rise, and it has risen since 2014. But in terms of the amount of housing stock that we have, we're building about 30 to 35,000 single-family homes a year. Okay. You match that up with the multifamily deliveries, and that's pretty much equilibrium to that 50 to 60,000 of household growth.
And how is this housing dispersed kind of geographically? So, obviously we talk about DFW. So there's the Dallas side, which, is Dallas, and then Collin County. And then you got the Fort Worth side, which is mainly Tarrant County. And then the Dayton County kind of, I guess, overlaps both. That's probably more on the Dallas side. But how is this stock coming on dispensed geographically?
It's really amazing when you look at most metros by submarkets, and we cover 45 submarkets in DFW. You typically see 1 or 2, like in Nashville, there's 1 submarket that's seeing all the supply, West End CBD. Even like in New York, it's only a few select submarkets that are seeing a massive amount of supply. DFW, we're seeing over a dozen submarkets with over 1,000 units under construction. So it's suburban, it's urban, it's Collin County, it's even in Tarrant County, it's West 7th, it's Uptown, it's the CBD, Dallas CBD, and the surrounding areas. It's pretty much everywhere, which is, I don't want to say unique, but it's definitely different.
So my perception is the Dallas side is about twice as big as the Fort Worth side on average.
Yeah.
Is Dallas is the amount of supply kind of proportional on the side, or is kind of the headline numbers that we heard about a year ago was that the Dallas side is certainly seeing on a percentage basis proportionally more supply than the Tarrant County side. Is that leveled out, or is that still kind of generally the case?
It's definitely still more over on the Dallas side. It really depends on where you draw the line. The mid-cities hasn't seen much supply at all. Arlington, South Arlington, Mansfield, that's seeing some. And then you've got over in Fort Worth, the West 7th Cultural District, and down the Chisholm Trail Parkway, and a little bit up in Alliance. But other than that, Tarrant County, not that much supply. The Dallas side, you've got all those population centers that I mentioned. Allen McKinney, Frisco, Plano, Farmers Branch, Addison, Carrollton. I mean, over 10,000 units under construction consistently over the last 2 or 3 years. That's ground breaks following completions, phase 2, phase 3, over and over and over. But they're chasing those Toyota, Liberty, JP jobs.
So for those developers to make any money, what rents do they have to charge on those units that they're building now? Like, do you have sort of a back of the napkin replacement cost on those units and then sort of rents per square foot that they have to charge to make those deals work?
That's a good question. I mean, it depends on the type of build. If it's a mid-rise wrap compared to, say, your old garden style, which are still getting built, I could say for Collin County, the building types, it's completely shifted from earlier this cycle or previous cycles to no mid-rise wrap, town center, or walkability to now that's 80-90% of what's being built. It's going to be your Texas donut, for lack of a better term.
So meaning you have your parking structure in the middle, and they wrap it with this. That's what a wrap construction is. Where before previous cycles is all garden style, meaning 2 to 3 story suburban style walk up stick built construction.
Exactly, and that's going to be associated with some kind of walkability, whether it's shopping, whether it's in the facility itself, street level retail, or it's going to be near an office, near Collin County. It's tough to say transit, but in some cases you have that, especially City Line and that area. But in terms of back to James's question, we're seeing rents now coming in close to $2 a foot up in the northern suburbs for a lot of those deals, and also in Las Colinas. So some of the JPI deals, street lights. I mean, these are nice finishes. These are very high quality buildings.
What's urban core? A lot of that stuff is, even more dense than the suburban stuff. What kind of rents do you have to get in the urban core to make these things pencil?
Urban core, then you're stratifying by the high rise versus the highly amenitized mid rises. The mid rises, you're still seeing $2 a foot to $2.40 or so in Uptown. The high rises, I mean, they're up to $3 a foot or more on some of those new Victory deals and some of the new ones on McKinney Ave.
That's a lot. So maybe kind of a lot of what we do here at Old Capitals, we lend a lot on the Class C and Class B multifamily, kind of the workforce housing, essentially is what we like to call it. I'm sure you call it similar. Maybe talk about that. What's kind of the general state of the market for the workforce housing? And then, obviously we'll want to kind of compare and contrast that to the new supply and those rent numbers that you just kind of mentioned.
Absolutely. And the B and C class, I might throw out numbers like 1 and 2 star, 3 star. That's going to be your 1 and 2 will be your C class. 3 will be your B class, just to get a little more granular. Okay. Sometimes I'll interchange between that, but it's been very strong. As we mentioned before, nationwide, the value add narrative, the value add trend, it's been so apparent, and it's really created a new level of the asset class in general. A lot of these properties were just dilapidated, old, not really taken care of, not well managed, and now they've been flipped multiple times in a cycle. They are professionally managed. Sometimes you add amenities, sometimes you don't, but it's really allowed landlords, and you guys would know better than I would, but allowed you to raise rents to make it work and make it pencil and make a great return. So what we've seen with that is just explosive rent growth, vacancies, occupancy still remaining high, even though there's been this spat of value add. So you have the renovations there, sometimes causing higher vacancies temporarily. But it's been a very strong market, and again, driven by that warehouse distribution, industrial, trade, transportation, logistics sector.
So it's been strong. So what kind of rental rate growth are we seeing kind of the B class or the 2-3 star, B, C class, the 2-3 stars as you guys rate it, compared to the Class A new development? What's kind of the differences in the rental rate growth?
As of right now, the difference, the B and C class still 4 and 5% annual, which is incredibly strong, more than double inflation. A class is around 1.5%, but that includes some of your older. I heard you guys talking in the last podcast about what your 2000 to 2009 vintage. That's different than this cycle, the highly amenitized and
so that's really kind of like A minus, right?
Yeah, you're A minus. So grouping the A minus in with the A, it's still worth 1% or so, and that's including just a stabilized series. So if we're adding a new building, that's not causing rent growth, for example.
So the A minus product, in my observation, is generally 20-25% on a nominal basis less expensive than the new stuff that's coming out of the ground. Is that generally what you observe as well?
Yeah,
it's almost B class product anymore, being 2008 and prior, compared to like the knocked out amenities and finishings that we're seeing on the brand new supply we've seen, say 2010 forward.
Right. And what I've seen, there are a lot of managers, capital firms like Olympus Property or Cortland Partners. They're going into some of those really well located A minus class and turning them into that A plus. at least for that area. So there's been success in that end as well, but then also turning from those B- to B+ and down to C.
What have they done in those properties to crank them up to new construction levels?
The resort style pools. I mean, pools, people love that. Just amenity centers, common areas, just improving that. And then the internal, the finishes. So everyone says that the granite countertops, the high end internal, all of the above. Just basically taking what you would put into a brand new building and putting it into these 2008, 2006 vintages.
So they might be taking rents from like what, $1.20, $1.25 up to $1.50. So still beneath the brand new stuff at $2, but there's still a good chunk of room in between.
Absolutely. And they're oftentimes they'll take it from the $1.20 to $1.50, and that will be the top of the market. So a lot of times these areas, we'll talk in Fort Worth or, Grapevine, a little tougher to build in this area, a little bit more regulations, more NIMBYism, if you will. So being able to take an existing property, it's less of a headache than building something new and going through permitting and going through all the regulations.
Okay. And then in terms of, what about pricing in terms of cap rates? What have you started to see on the BNC stuff in the last couple of years and recently?
Yeah. How does that compare to the A class too?
There's still definitely a spread there. I heard you guys talking, hearing some 5 cap in place for BNC, and I've seen things like that, and you have to call up your CoStar researcher and like I'll do that and say, what's really going on here? Is this real? And really have them dig into the numbers and what they've heard. But yeah, we've seen that here or there. But in general, you still have, your B class, your 6s, low 6s, high 5s, and then your A class. It can go to your high 4s in, say, like some of the new deals in the CBD, in the farmers market area, or in West Dallas.
So you're seeing high 4s for A and you're seeing high 5s for B. What about C?
All over the map. I mean, that can just be 6.5 plus, and then you still have these deals in, say, South Dallas or some of the shadier Oak Cliff areas, or
lower socioeconomic areas.
Right. It's the Cedars, but it's not the Cedars. But you could still see a 7.5 or an 8. But it depends on the deal. But in general, we've seen the compression. The compression's kind of leveled off. Interested to see what starts to happen with the rise of interest rates and if that's going to actually cause any kind of an inflection or anything going forward.
James, Paul, when's the last time you saw something with the 6 in front of it? We're guys on the street, right? So we're looking at all this stuff, and
it all depends if you adjust taxes. So it might be 6 on in place numbers, but yeah, once you adjust taxes, put new insurance numbers on there, and put in the new interest rate, it definitely is very, very difficult to buy anything sort of north of 6.
What I'm seeing, David, kind of on the street is, you go back 4 or 5 years ago, the A stuff was probably, 5, maybe low 5, and the C stuff would be 8.5, 8.5, B kind of in the middle. And anymore now, the C stuff, it's hard to get a 6, especially if there's everything's a value add, right? All the brokers, everything's a value add. So, they're putting it in there. So you're having to overpay so much for the value add, right, that, all the spread between an old, 1960s vintage and the brand new stuff seems to be, almost non-existent on a cap rate basis. That's what it kind of seems to observe. That, Paul, you have anything to add?
Just that we're so mature in the cycle right now that these deals have been rehabbed not once, not twice, but 4 or 5 times. And so how much is left on the tree, so to speak, on a deal that was built in 1964? I mean, can you take the mansards off and can you take it to a pitch roof from the flat roof? Can you put more amenities in the property that the center of the property has a swimming pool? I mean, it's tough.
So like South Irving, right?
Yeah.
So if BNC guys are overpaying a little bit right now, just with the way cap rates are compared to the A stuff, what risk hit the BNC stuff that maybe don't affect the A's? Is there anything out there that we've raised rent so much now? Is there anything sort of in this workforce housing that is going to hit that group before the stuff in the A?
And that's absolutely it. If you look at income growth versus rent growth, since 2015, rent growth has really outpaced income growth in DFW. So, you see that spread and it starts to get concerning. We haven't been hit with it yet, but that's not sustainable. Historically, rent growth and income growth grow at pretty much parity. So if we see that, I would expect income growth to pick up especially with the tight labor market, with the economy really rearing. And you hear the national numbers, haven't really seen anything on the local level just yet, but I would expect that to tick up. But that's definitely a concern where we're just pricing people out. And then to that point, a lot of the submarkets that have seen the best rent growth in recent quarters were actually Johnson County, Ellis County, Hunt County. I mean, places that probably no one's heard of listening to the podcast, but it's a little bit of a trend where you can imagine people who are used to paying $500 or $600 a month for their small one bedroom in the mid cities. They can't find that anymore.
It's 800, right? It's hard to find anything less than 800 nominal rent, not in the hood, right?
Exactly. And you know what? We're a driving culture in Texas, and some people will just pack it up and say, I'll move out there for the affordability or to buy a smaller house if they can afford it. But seeing that type of a trend, it starts to make sense that people are starting to get priced out. Now, we're still seeing all this great job growth and the in-migration, which is covering over it to an extent, but to see that the rent growth's been the best in these outlying submarkets where there's, pretty much not that much inventory and a spike in demand, it's a pretty telling sign, I think.
Is that common across the nation and similar metros?
I have not looked into that, but I don't.
Affordable housing across the United States is probably the number one concern for everybody. I mean, we are just pricing people out of the market, just like you were saying before, Mike. 5 years ago, 10 years ago, we were paying $600-$700 a door. Now we're paying $1,100-$1,200 a door. These people are not making the same. They're making the same amount of money. They're making a little bit greater than they were, say, 7 or 8 years ago, but they're not making significantly greater. So, I mean, I'm very concerned about affordable housing, not just in Texas, but throughout the United States. And that, I think what we're going to see happen, though, is that we were looking at when we were checking affordability for folks, we're using 2.5, 3 times of income to see if they can actually pay the rent on there. I think there's just going to be a change, just like they do in, say, San Francisco, because they make pretty much the same income as they make in Dallas versus San Francisco, but we don't have state income tax there. They do. And their rents are, I don't know,
more.
A lot more. So that maybe they'll go from 2.5 times to 2 times or 1 3/4 or so. We'll just do a reset of what we think is normal to continue to charge higher rents.
I would say to that, the only difference there is transit or accessibility to jobs. If you have that transit, affordable transit, if DART was rearing at 100% what they projected it to carry, and we had strong transit-oriented developments like that in these underserved, lower-income areas, I would say that's more feasible. But if you still have to have a car payment or have an old car that's breaking down just to get to your job, that's a concern. And that's a different level than even what you'll see in the coast, where access to transit can be a little bit easier.
So maybe back to DFW for a minute. What are some of the best submarkets in your view? So maybe kind of talk about the top 3-4 submarkets that you like. Is there any 1 or 2 that kind of put you off or you're a little concerned about maybe kind of the future of them? So just kind of any sort of submarket by submarket of Dallas-Fort Worth that, in David Kahn's opinion, where should people be putting their capital to work?
Well, I've been trained not to give investment advice, but I will say I do love the Farmers Branch, Addison, Carrollton, Mid-Tollway area. You just have a lot of strong fundamentals there, and meaning access to highly educated people, and that's from the office perspective. A large office employment base, very commutable to all parts of the Metroplex, easy to get to both airports, and just a huge variety of stock, 80,000 units in that submarket. Farmers Branch, Addison, Carrollton, and that's one of the biggest submarkets in the entire country. And it's really not that big of a geographic area. It's just a lot of dense apartments. So whether it's your C class or your B class or your A or A plus now, that submarket is almost like a market in itself. And you get that accessibility to people who, sometimes a couple, they one works in Irving, one works in Frisco, or one works in Uptown and one works in the Galleria. And you kind of have a best of both worlds there for a commute.
What else do you like locally as far as other submarkets? Maybe 2 more submarkets that you like in the area.
Sure, I like Oak Cliff a lot. I like what they're doing down at Bishop Arts, and I think that's really only the beginning of that area really exploding in terms of, we talk live, work, play. At least live, play It's been a great area, but it hasn't had that real high-end apartment stock yet, and it's about to happen this year. So I'm excited to see what happens down there. And really, if that spills over into kind of that Lake Cliff area to the east, and to see if there will be more of a push for value add there, and what types of people will go in and rent in those areas.
Is there anything on the Tarrant County side that you like over on the Tarrant County side?
Yeah, I like the whole Southwest Fort Worth with the Chisholm Trail. I like that story, just all the development going on there over the last 5 years or so. It's been pretty exciting over there. You don't see WeWork go to an area, a submarket where they don't think there's a possibility of either live, work, play, or some kind of an exciting neighborhood feel, techie type, and you see WeWork going there, and you see WeWork going up to Legacy and doubling down in Legacy. So I think that's a pretty telling sign for those two areas. But yeah, Southwest Fort Worth, again, a lot of diversity in the apartment stock. You have some of the older, you have some of the newer. Great accessibility to downtown Fort Worth now, which you really didn't have in prior years.
So two of the areas, I don't want to taint your answer here, but two of the areas that certainly have seen massive rental rate growth that I've missed, that kind of historically have been tougher locations. Dallas side, like Lake Highlands or Victory Meadows, which are pretty close to each other. On the Fort Worth side, pretty much anything east of 35, so kind of East Fort Worth, have seen massive rental rate growth, and then the corresponding sales prices of these places have gone through the roof. Is there any submarkets you don't like? Those are two that have me kind of personally concerned. Are there any submarkets you echo my concern, or do you have any different ones maybe on either side of the metropolitan area that seem to be a little bit out of whack economically?
It's tough for me to say that, because in terms of out of whack, I look at just supply and demand, and a lot of times these oversupplied submarkets. So Frisco is just seeing a ton of supply. I love the Frisco story. I love what they're doing up there. The EDC, they're active. The city. But 5,000 units under construction is 5,000 units under construction. So it's more like going in with expectations of you're not going to lease up with no concessions and see 2-3% rent growth. And I think that was kind of missing from some of those deals over the last few years. I think people are starting to reassess what's feasible up there. Similar for Uptown, everyone just chasing those big high-end deals. Victory as well. You're not going to get the 20 units a month lease up that you were going to get in 2015 on those new deals, and they're not. And the concessions are rising. People are concession hopping. So it's really the supply story. Where there's supply, there's going to be a ton of competition for renters. It could be the highest demand submarket in the country. You're going to see people concession hop, and there's going to be structural issues because of that. So really, it's the expectations there. But in terms of what they're building, the quality of product, it's all exciting. It's all great for DFW and great for us as a metro. So in terms of an analyst, sometimes lower rent growth, it can be bad. It's fair to say that. But when you see what's going on and what people are building, it's exciting.
So we've been super positive on DFW. Anything that we should be looking out for in terms of the end is near for DFW? It seems like everything we've said is great.
When's the tsunami coming?
Is it tsunami Amazon? Or that's one type of tsunami. Our economy, the DFW economy, is so tied with the nation as a whole. As the nation expands, DFW expands. And if we pull back, that's going to hit us as well. But if you look at the diversity of the types of jobs, it's a very safe play when you have all that logistics space. You have us at the crossroads of the country, and just the intermodals and all the transportation. We build up from there. And then, as I mentioned earlier, the release valve for these office jobs. The moment that another Toyota decides that we're not having our people live and work in towards California, where home prices are 10 times incomes, we're going to come to Plano where it's 3 times or 2.5 times. We're going to continue to benefit from that. And then in addition, just the live, work, play, the sense of place that we're starting to develop really in downtown, uptown, this area surrounding uptown, it's been really exciting this cycle. And we really didn't have as much of that earlier in previous building cycles.
David, welcome to the Smartest Guy in the Room Club, the newest member. I'm not in it yet, but I know James.
Maybe one day.
But James and Michael are. But you tell a great story, and we appreciate you being in the podcast. Is there anything that we haven't covered that you'd like to cover?
No, thank you guys for having me. I was excited to be here and I appreciate it.
Yeah, if anyone wants to know more information about or learn more information about you or your company, what's maybe like a resource or two you can give out for people to know more about CoStar or yourself, or maybe reach out to you guys?
Yeah, you could email me at dkahn at costar.com, or just go to www.costar.com, loopnet.com, apartments.com. We're all over the place.
Yeah, my company SPI, it's inevitable, but you guys are so big that we certainly use apartments.com to advertise virtually all of our apartments, as well as we have a subscription to your data service that we use when we're analyzing potential apartment deals or just kind of looking at our existing portfolio. So it's a very good resource that we personally use. So I'd definitely give it a thumbs up, if not two. So Paul, if you want to, what else we got going on in the old capital world that we haven't talked about?
What we haven't talked about recently is the 15-page white paper report that you, Michael, and James and I wrote a year or two ago. I think that's a good basis for people that want to learn a little bit how to structure these transactions. And then you also have in there your due diligence report. So make sure you go to oldcapitalpodcast.com and get that downloaded, and then you can kind of understand a little bit more of the basics.
I'll pound the table again. We have the next speaker series March 28th at the Grapevine Convention Center, and upcoming the Old Capital second annual conference in the AT&T Stadium on September 13th. More information to sign up for both, you can go to the same website, oldcapitalpodcast.com.
David, thanks for being on the podcast. I appreciate that.
Thank you.
James, always a pleasure.
Thanks, Paul.
Michael?
See you next time.
I'm Paul Peoples. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.